Thanks for staying with us on Smart Money. We're having a very interesting discussion on all the big themes that you need to invest in as we head into the next leg of this bull run with the Nifty at 18,000 this week. Gurmeet Chadha has been with us and he has spoken about many themes. We discussed the first two themes, which is mobility as well as the manufacturing theme, and they'll come up for you on your screen in just a bit. Within that, in case you missed out on the stocks, M&M, Uno Minda are the companies that he discussed. There's also Dixon Tech as well as Tata Chemicals. But let's move to the next hot theme, which is defense, right? Out of nowhere, this theme has come back into action. But there are many of these companies, Gurmeet, that have issues, whether it's promoters selling stake, whether it's balance sheet problems. So just sift the wheat from the chaff for us, which are the companies to look at?
So you're right, that's not PSU-dominated themes, and defense orders take 7-8 years to execute. So sometimes we get carried away by the order book, but the cash flow can happen over, there's a milestone payment. So you have to look at the continuity in order book and not just one particular order, because that impact probably will come 5 years, 6 years down the line. So one thing which I have been liking and been lucky in terms of getting early solar industries, it started off as an industrial explosives player, then got into explosive initiating systems. So their base business is doing very well with demand picking up from exports. There's a power shortage. Coal India is their largest client. So that's drawing more explosives to mine more coal. Then infrastructure is again the end-use segment for explosives. I think where they've started doing well is the defense segment. So their defense order book is already crossed, good milestone. They are supplying hand grenades now. The Pinaka missiles are now on the final stage of testing, so that's done. They've also just submitted a 30 ammunition to Indian Navy. They've got into drones. They are working with ISRO on a satellite propellant. So it's a complete new segment they are getting, and there's great guidance on the order book. So defense can probably add 500-600 crore to the top line.
I think you've been bullish on solar industries for now 3-4 years. And it's been what, a 2-3 bagger already or more?
Oh, so it's more than, so last 4 years probably will be a 5 bagger. Since inception in 16 years would be, I think, 75-80 bagger.
Wow.
Very undiscovered, very little. Yeah. Because what happens is a lot of the business they get in a subsidiary called economic explosives. So people don't know that it's a subsidiary for solar. So defense again is happening on economic explosives. So people are tend to, and little below the radar. FIs have just started, institutional buying has just started probably in 2-3
Any
years.
red flags here? Because the stock has rallied quite a bit.
So expensive, and in between there were, the ownership dispute with the senior and the young, but that's behind, that's way back. So it's completely sorted. There's a second generation which is driving it, and very, very hardworking, and because we meet them very regularly in our site, they have come up with a weapon assessment range where you test weapons, right? Wow. So very high entry barrier. Who will make a weapon or a hand grenade these days if you are a startup, right? You don't want to go, it's a tough job. So very high entry barrier as well.
Okay, that's good, right? I mean, investing in companies that have high entry barriers. Any other stocks in this space?
So we track HAL, we track Bharat Electronics. There are a few there, HAL in particular. But solar remains the top.
That's your top pick in defense. Okay, the next theme, home improvement. This as well is a space that you've liked for a very long time. There are so many ancillary spaces, right? We start with real estate, then there are consumer durables, there's home improvement, there's paint, cement, and you track all of them. Yep. What are the top picks here?
So there are 42 sectors linked to home improvement, right? So it in itself is a theme, right? So since an interest of time, we cover Polycab. That's again been an old favorite for some time. I think why I like them is the fact that they're moving towards B2C from B2B. There's premiumization happening. So in cables and wires, they are 24% on market share, and that segment is still 50% unorganized. So the base business will continue to do well. They've guided for 20,000 crores top line now. They're currently at 12,000 crores. So there's a roadmap till FY 25-26 clearly for 25% top line growth. Their fast-moving electrical goods segment is now registering 40% CAGR for last 5 years, which is fans, heaters, lighting, etc. So both segments coming together 29 times. Some of the stocks are much more expensive, Havells, etc. So I think that's a very good balance sheet, good return ratios as well.
I've noticed that you pick stocks that are extremely expensive. I mean, I understand that many of these are market leaders and they're doing well, but are there any stocks which look good even from a valuation perspective?
Yeah, so as I said, M&M is not expensive. It's at 17 times. I think Polycab relatively in the sector is the least expensive. Okay. Your Havells, etc. Others are like 40, 50. Voltas is very expensive. Paints are like 60, 70 Ps.
For some reason, Voltas has not done that well. Any reason for that?
See, I think their institutional business, which is their engineering, is something which has been very erratic in terms of, and then been affecting their working capital. Then there was COVID disruption. There was working capital issues. On the RAC segment, the AC segment, they seems to be now gaining market share. They're almost 26% now. So if they can get this working capital and improve return ratios a bit, I think should.
Okay, so that's the fourth theme. Folks, polycab in the home improvement space. The last and final theme is financialization of savings. And within that, your top picks have been?
So CDSL has been an all-time, favorite. I think we've discussed it multiple times in various interactions. CAMS is another, related thing. So it's the RTA, which is the bookkeeper for mutual funds in simple language. 70% market share, duopoly structure, and top 4 out of 5 AMCs deal with CAMS. And now even the PMS AIF segment have started using CAMS. So there is a 50% share, and more PMSs and AIFs getting launched. They're also now very gung-ho on this aggregator thing, which is what lenders and financial planners will use. So what UPI has done to credit and payments, something can happen if there's a regulatory push there. Insurance depository was soft. With now this e-policies getting issued, probably that will get a leg up. And they are in this payment. So it's like a fintech play, annuity model. You charge on the AUMs. And the AUMs for mutual fund industry are now growing at 15% for last 12, 13 years. I've been tracking this industry.
Okay.
So very secular play. Yeah.
All right. And no red flags here for both these names?
No, not really. I mean, it's been in a consolidation. It's corrected a bit, almost like 25-30% from its peak. It's still a little premium to listed AMCs. But that's the reason, because it's a duopoly structure, sticky businesses, and it's gaining market share over Carvi. So there are only 2 players in this segment.
All right. Well, we have to thank Gurmeet. We could have gone on and on. His, wisdom is endless. And of course, we'll have to get him on another day. But these are the 5 big themes that you need to look at if you want to capitalize or if you want to sort of grow your corpus. Now, since we're talking about 5 themes, we've also decided to give you some financial tips. Let me thank Gurmeet for joining us. Gurmeet, thank you so much.
Pleasure.
And, on Smart Money, we've decided to give you some tips to get healthy financially, right? So every week, we're going to give you one tip. And the tip for today is why you should invest in index funds. 5 reasons for that. Now, index funds, as we all know, benchmark the index. So it helps you with a well-diversified portfolio. It follows the benchmark index and invests in companies that make up the index. So that's one of the reasons, a well-diversified portfolio. The second reason is safety. It's one of the most secure equity funds because the portfolio consists of quality large and mid-cap index stocks. It's less susceptible to market fluctuations as well. The third reason to invest in index funds is a low fees. Now, passive or index funds charge a fees of around 0.2% versus 1% fees that you would pay if you're investing in an active fund. The fourth, and I think the most important, is no fund manager bias. If you invest in an index fund, you're free from any fund manager biases. There's no chance of a fund manager picking up underperforming stocks. And the fifth and important part of investing in an index fund is steady returns. Now, on an average, the returns in an index fund has been in a range of 13 to 15% in the last 3 years. Now, I saw Gurmeet nodding aggressively, so I want to get a final view from you, Gurmeet, on it. Do you think for an investor who perhaps can't do research, right, index funds is the way to go?
Oh, absolutely. It's not about this versus that. I think index should be part of the portfolio. 70% of the funds have found it difficult to beat the index, which is what, so as market becomes more efficient, it becomes increasingly difficult to beat the index. Also, as you rightly said, there is no emotion involved in selecting stocks. So whatever is in the index, and sometimes one part of the portfolio should be emotion-free, free of biases. So that helps, and obviously more cost efficient. And index funds, they keep doubling every 5-6 years, because if you see last 40 years return of sensex, for example, yes, it just doubles every 5.5-6 years. So very, very smooth, no frill. No serious
Sleep
tracking
peacefully at night kind of investment.
So again, in a large cap bit, some part should go to index funds.
Okay, well, folks, that is your financial health tip of the week. And with that, it's a wrap on this edition of Smart Money. Thanks a lot for watching.